it's Josh. Today we're going to be talking about the 3 best defensive stocks to buy today in 2023. Unless you've been living under a rock, you've probably noticed that there's a big problem in the banking sector right now with Silicon Valley Bank, Signature Bank, and even Credit Suisse has caused a big mess, and it's too soon to tell what will happen next. We'll see. Besides that, interest rates are rising. The Fed is trying to stop inflation. There's a lot of headwinds out there. It's actually very confusing. So, the question is, now what's going to happen and what should I do? Well, like a lot of people, I think we're headed for a recession. Do I know that for a fact? No, nobody knows that for a fact. I'm no Miss Cleo. I'm not going to stand on the table and tell you that I know exactly what's going to happen. Nobody does. When times are rough, sometimes the best stocks to buy are defensive stocks. These stocks come from everyday goods and services with stable earnings during good times and bad. Here are a few that I strongly believe in. So the first stock that we're going to recommend today is Newell Brands, NWL. It has about a $5 billion market cap. It's the maker of Sharpie markers and Rubbermaid containers. Priced at about $11.40 about right now. Has about a 7 to 8% dividend yield. However, the question becomes, is it well capitalized enough to pay that dividend yield? There is some concern about that. It does have a little bit of a debt. This is not a perfect stock to buy. Usually a company isn't completely perfect, but the upsides outweigh the downsides here. They recently had a management change. 2 of the larger activist investors out there, Carl Icahn and Ken Griffin, are heavily invested in this. They changed out management, and so hopefully operations is more efficient in the future. So earnings is supposed to grow substantially over the next few years for this company, as long as they're able to hit their targets and be efficient, which with new management, that is the hope, right? At the price it's selling at, the PE ratio that you're getting, earnings growth into the future, dividend yield, this company, even if there's a recession, they're going to be able to produce products that people buy. People will always buy Sharpie markers, they'll always buy containers. They're well diversified into many different industries. So if one segment is kind of feeling a little bit of pressure, another one will pick up a little bit of slack. So first stock to recommend is Newell Brands. The second stock that we're going to recommend today is Archer Daniels Midland, ADM. It has about a $41 billion market cap. Archer Daniels Midland has a 2.4% dividend yield. So you're going to get a dividend from investing in this stock, which is always a nice bonus. It is a food processing and commodities trading corporation. Over the last 3 or 4 years, its stock has jumped up quite a bit. It's been able to exceed expectations. The CEO of Archer Daniels Midland is Juan Ricardo Luciano, I think that's his name, if I'm reading that correctly. So why that's important, again, this company over the last 5 years, since this guy's been CEO, they've exceeded expectations. If you have good management and they're able to every quarter, whatever the plan is, meet the plan or beat the plan, that's a stock that's going to go up. Not all companies hit their plans. So when you see these future earnings goals, these future expectations, sometimes they don't hit it, and that's why a stock will tank. So on the flip side, the negative thing is people expect their earnings to decrease over the next few years by about 9%. Now listen, over the last few years, they've grown substantially. But now that it's at 78, it's actually at a really good price. There's less downside than there and more upside. Again, it's in the food processing industry, whether there's a recession or a good time, it's going to perform. It's going to sell product. People are always going to need this company. And although we're expecting earnings to decline, because I believe in this management team so much, this is kind of what you have to think. Like, even though it's going to decline by 9%, the price per earnings, future price per earnings ratio, it's not expensive. It's not that expensive. Smart management teams usually under promise and over deliver. Number 3 is Dole, D-O-L-E. Everybody knows what Dole is. It's the banana company, right? So right now it's selling at about 12.5 times earnings at about $1 billion market cap. It has about a 2.8% yield, dividend yield. So again, you're getting a little bit of a dividend yield, which is always a nice bonus. They've recently expanded into more exotic produce segments. So mangoes and avocados are kind of the 2 big exotic produce segments that they've kind of entered. under their B Exotics brands in Europe and Dole Exotics domestically. So because of that segment, they have a little bit of upside. They're expecting over the next few years earnings to grow. Right now, it's selling at about 12.5 times earnings. You're expecting to be at like 11 times earnings in a year, which is not an expensive valuation for a company, especially like one as well known as Dole. You're getting a dividend yield and you're expecting earnings to grow. So over the past year, they've had a little bit of a rough time with foreign currency translation and logistics. And if you're expecting things to kind of normalize a little bit, that should help with their profitability. We're always going to process foods. We're probably always going to use Rubbermaid. You know, in good times and bad times, those are things that are always used by people. So that's why we consider these defensive stocks. Historically, again, they've outperformed the market during recessions. Things are in turmoil when things are going down. These should do well. We're always going to buy bananas. We're always going to process food. We're probably going to buy Sharpies no matter what, buy Rubbermaid. So that's why even during bad times, during recessions, defensive stocks outperform. So I'm very confident in these 3 stocks. I feel like they're going to outperform. They're going to do well even if we hit a rough patch. Thanks for listening. I'm not a financial advisor. I have done research in the past. You know, this is for entertainment purposes only. Even when you plan things out perfectly, sometimes crazy things happen. Things don't always go to plan. So just remember, don't leave all your eggs in one basket.